Real estate versus stocks, which builds wealth faster? Welcome to Abiding Bricks and Wealth, where financial intelligence meets long-term wealth creation. Today's topic tackles one of the most debated questions in investing: real estate versus stocks, which builds wealth faster? Both asset classes have created millionaires. Both have risks, rewards, and unique advantages. But when it comes to building lasting wealth, not just quick profits, the answer depends on understanding how each investment grows, compounds, and protects capital over time. This video breaks down the numbers, the psychology, and the strategies behind both markets. By the end, there will be a clear understanding of which path or combination can accelerate wealth building most effectively. Section 1. The foundations of wealth building. Wealth building is not just about returns, it's about compounding, leverage, and time. Three key principles drive long-term wealth: capital growth, the increase in value of an asset over time; cash flow, the income generated from that asset; leverage, using borrowed money to amplify returns. Both real estate and stocks can deliver these, but they do so in very different ways. Understanding these mechanics is the first step to comparing them fairly. Section 2. How real estate builds wealth. Real estate is a tangible, leveraged asset that grows through multiple channels. 1. Appreciation. Property values tend to rise over time, driven by inflation, population growth, and limited supply. Historically, U.S. real estate has appreciated around 3 to 5% annually, though local markets vary widely. 2. Cash flow. Rental income provides steady, predictable cash flow. Unlike stocks, which rely on dividends or selling shares, real estate can generate monthly income while still appreciating in value. 3. Leverage. Real estate allows investors to control large assets with relatively small down payments. For example, a $400,000 property purchased with 20% down means controlling a $400,000 asset with $80,000. If the property appreciates 5%, that's a $20,000 gain, a 25% return on the initial investment, excluding cash flow. 4. Tax advantages. Real estate offers powerful tax benefits, depreciation deductions, mortgage interest write-offs, 1,031 exchanges to defer capital gains, potential tax-free gains on primary residences. 5. Inflation hedge. As prices rise, so do rents and property values. Real estate naturally protects purchasing power over time. Summary: real estate builds wealth through appreciation, cash flow, leverage, and tax efficiency, a combination that compounds powerfully over decades. Section 3. How stocks build wealth. Stocks represent ownership in companies and ownership in innovation, productivity, and global growth. 1. Capital appreciation. Over the long term, the stock market has delivered 7 to 10% average annual returns. This growth comes from corporate profits, reinvested earnings, and economic expansion. 2. Dividends. Many companies pay dividends, regular cash distributions to shareholders. Reinvesting dividends accelerates compounding, turning modest returns into exponential growth over time. 3. Liquidity. Stocks can be bought or sold instantly, offering flexibility that real estate cannot match. This liquidity allows investors to rebalance portfolios quickly and respond to market changes. 4. Accessibility. Anyone can start investing in stocks with minimal capital. Fractional shares and index funds make it easy to diversify across hundreds of companies. 5. No maintenance. Unlike real estate, stocks require no physical management, repairs, or tenant issues. Investors can grow wealth passively through automated investing strategies. Summary: stocks build wealth through compounding returns, reinvested dividends, and global economic growth, with unmatched liquidity and scalability. Section 4. The power of compounding. Compounding is the silent engine of wealth creation. It's not about how much is earned in a year, it's about how long the money is allowed to grow. Example: $10,000 invested in the stock market at 8% annual return grows to $100,000 in 30 years. $10,000 invested in real estate with 5% appreciation and 10% leveraged return can grow to over $200,000 when factoring in cash flow and equity buildup. The difference lies in leverage and cash reinvestment. Real estate compounds through both asset growth and debt reduction, while stocks compound through reinvested earnings. Both can outperform the other depending on how consistently profits are reinvested. Section 5. Risk and volatility. Every investment carries risk, but the type of risk differs. Real estate risks. Market downturns can reduce property values. Illiquidity. Selling takes time. Maintenance and tenant issues. Geographic concentration risk. Stock market risks. Market volatility. Prices can swing daily. Emotional investing. Fear and greed drive poor decisions. Inflation risk if returns don't outpace rising costs. Risk mitigation. Real estate, diversify across markets and property types. Stocks, diversify across sectors and global indices. Both invest long-term and avoid emotional reactions. Section 6. Historical performance comparison. Over the last 50 years, U.S. real estate, average annual return, approximately 8 to 9%, including rent and appreciation. U.S. stocks, S&P 500. Average annual return approximately 10 to 11%, including dividends. However, real estate's leverage often amplifies returns beyond what stocks can achieve with cash alone. For example, a 5% appreciation on a leveraged property can outperform a 10% stock return on unleveraged capital. Volatility. Stocks experience more frequent short-term fluctuations, while real estate moves slower but can face deeper corrections during crises. Over time, both have proven resilient wealth builders, but their paths differ. Section 7. Psychological and behavioral factors. Wealth building isn't just math, it's mindset. Real estate psychology. Tangible asset ownership creates emotional security. Long-term holding discourages panic selling. Active management builds discipline and financial literacy. Stock market psychology, easy access can lead to overtrading. Emotional reactions to market swings can destroy returns. Passive investing strategies like index funds help overcome behavioral biases. The best investors master their emotions, regardless of the asset class. Section 8. Combining real estate and stocks. The smartest wealth builders don't choose one. They use both strategically. Balanced portfolio. Example, 60% real estate provides cash flow, leverage, and stability. 40% stocks provides liquidity, diversification, and growth exposure. This combination balances risk and return, allowing investors to benefit from both tangible and financial assets. Real estate builds steady wealth. Stocks accelerate compounding. Section 9. Strategic takeaways. Real estate best for leveraged growth, cash flow, and tax efficiency. Stocks best for liquidity, scalability, and passive compounding. Together, they create a diversified wealth engine that compounds faster than either alone. The key is not choosing one over the other. It's understanding how to use both intelligently. Conclusion: real estate and stocks are not rivals. They are partners in wealth creation. Real estate builds stability and cash flow. Stocks build scalability and liquidity. The fastest path to wealth is not about chasing returns. It's about strategic balance, patience, and disciplined reinvestment. For more insights on building lasting wealth through real estate and smart investing, subscribe to Abiding Bricks and Wealth, where financial wisdom meets real-world opportunity.